today we're talking about inheritance. We're talking about how do you transition property from one to another. And what we see, clients, especially when they're new to us, when they first come in, they have these thoughts. Hey, isn't this how I'm supposed to do it? Or won't it be easier if I just do this? There's some consistent themes that we see. And I'm not sure where people pick these up always, but this is probably one of the areas where I see the most disinformation or misinformation where
right.
they're just wrong in what the benefit is going to be or not be. And when we explain what the impact of what they're about to do is, often they step way back and they say, oh yeah, we don't want to do that. And the big one that I see is, just as you talked about, like they want to put their kids on the title to their home. That's a big one. I think a lot of people say, well, they're going to get it anyways. It'll be easier, won't it, if I just put my kids on title now? And the answer I would generally say is no. Like, don't do that. Talk to a professional before you make any sort of those title changes in your real estate. And the big one that we've talked about a little bit before, but we'll just talk about that dynamic of what happens when you inherit property, especially real estate, and especially if it's like a rental property. When someone inherits it, there's some really great tax benefits that happen in that moment. In fact, a lot of the capital gains that would have built up during the parents' generation, maybe they've owned it for 20, 30 years.
Right.
And the parents say, we would never sell this because there's so many capital gains built in there. Well, at the time of their death, and states are a little different, and there's some specifics here, but generally at the time of their death, they'll get a step up in basis. So when the next generation receives it, all those capital gain taxes that existed, they're just gone. They've vaporized.
So to kind of give an illustration to our listeners, so if you have a house, let's say that your parents bought for, and let's just take the personal residence. They bought this a long time ago. They paid $100,000 for the house. And they want to put you on title as when they die, it just automatically transfers to you. What happens is that if you go to sell that home after that event, let's say your parent has died, and all of a sudden the house is not worth $100,000, it's worth $700,000. It's gone up significantly over the decades, and you go to sell it, the tax man comes to your door and says, okay, I want you to pay taxes on that $600,000 of gain.
Yep, that's the difference between the $100,000 to the $700,000. That difference,
right, on the purchase, that. Whereas if you inherited that property, there would be what you talk about as a step up in basis. That again, we get this jargon in our head.
Yeah.
So understand is that there's a complete step up. In other words, a reevaluation of the cost. So you could sell the property at the next day for $700,000, and you would pay no tax.
Yep.
And when you put that down on paper, people go, "Oh, I didn't know that."
Yeah,
and it's a big deal.
It's a big deal. Yeah, and for a lot of clients, when we talk through this, the reason they're thinking about putting their kids on the title, the reason their parents want to do that is often some sort of control, and this just to make it easy.
Sure.
And when we explain the tax impacts of that, when that they perk right up and say, "Oh, I didn't realize what that would do." If I'm on title, then those taxes are going to survive my parents' death. Whereas if I'm not on title, those taxes are going to pass away with my parents, and I'll be tax free. That's the first one. The second one we often talk about is, Randy, if you and I owned a piece of property together, your name's on it, my name's on it, and I get in some sort of a car accident and someone sues me and has a judgment against me, they're going to look at everything that I own. And one of the things that I at that point could own is the property that you and I both have our names on. And so we've had that concern as well to say when you add someone's name to your title, you're kind of combining the liability profiles of both families. And so if mom and dad got in an accident, if younger generation got in an accident and there's some lawsuit that exists, they're going to look at those assets and you saying, oh, well, that's really my parents' house. That's not going to cut it, right? You're going to have some crossover liability, which you can avoid both of those things, the taxes and that crossover liability, by using a trust.
And there's different ways to do that. I mean, a trust obviously is one way where you have a successor trustee, or there's a structure for administration. But you can also title the account like a bank account. You can do a transfer on death.
Yep.
So if you die, it transfers to your child. But during your lifetime, like you're saying, the example that you gave, if the child has an accident, there's not a shared liability. There's not something where the attorney is going to come back and say, oh, you own that $400,000 account, so therefore we're going to take some of that money to help pay for the liability for your accident.
Yep.
And
Right.
you're creating that barrier, that wall in between the event and the results, right?
Yeah. So I would say the first, when you think of inheritance and kind of passing assets from one to the other, that's the first conversation I would say that we have with most clients coming in. We talk about the tax impact of waiting until inheritance. We talk about how you get names on things, accounts and real estate in ways that are
Right.
useful. So this is kind of the first we talk about. The next that I often hear, and I think you hear this as well, is people walk in with this idea about gifting. They say, hey, I'd like to give some money to my kids or whoever it would be, but I know I can only give 18,000. I know I can only give a certain amount, and that's a really
It's a really misunderstanding, right? I mean,
yeah, it's a common belief of that's what you can give, and then the question being, oh, what happens if you gave more than that? And most people, they don't have an answer to that. They just say, I don't know. So what we can walk people through that of I was going to look it up. I hadn't looked at it before. Last year, 2014, it was 18,000 is what
2024.
Yeah. Sorry. When I say 2018,
I know we want to go back, but I don't think we want to go back that quickly.
That is years ago. That's funny. 18,000 for 2024. Thank you, man. That's a blast from the past.
Yeah.
So that's what you could give without having to file a tax return, without having to tell anybody about it, without having impacts with the IRS. And you think of birthday presents or money you put in a card for somebody. Like, it covers all that stuff. No big deal. You could give 18,000 to one person. Well, what happens if you go over that amount? If Randy, you're feeling very generous and decide to give me $20,000, wonderful. It's so kind of you. And as you do that, what the law would generally require is that you file what's called a gift tax return. So
gift tax return. That means I got to pay taxes on that, right?
That's what people think. Yeah, the answer is no. You don't have to pay taxes. I don't have to pay taxes. What the 709, it's a gift tax return. What it does is it notifies the IRS and says, hey, I gave somebody a gift and it was a little bit over the annual exclusion. The 18,000, that got excluded. We don't need to think about that. But that 2,000 extra dollars, that little bit extra that I gave to Jeremiah, that money, I need to have the IRS log it, because your lifetime exemption, that the large amount that you have the exemption from.
And how much is that currently right now on a per person?
It's around 13 million. So you and your spouse, I know it's a lot of money.
I can give you up to $13 million and you don't pay any taxes.
I would love to receive it. That's great. Yes, that's right. Like that
right?
So the amount that your estate, if you were to pass away, things up to $13,000 would be covered, and you don't have to pay an estate tax. And being married, you get double that. So 26,000 for most married couples, that's what you have. So as long as all your houses, your investment accounts, all those things are under that amount, you don't even have to worry about estate taxes. And so getting back to this idea of gifting, if you had given me a gift and you had to file a 709, it takes that $26 million exemption and it takes away, in that example we had, $2,000. So now you have $25,900,000. It just takes it down a teeny tiny bit. And for some families, where they're going to blow right past the exemption, they have a $50 million estate, it's really important to be really mindful of that exemption, because every dollar that gets reduced by, you're going to have to pay estate tax on your estate, and it's about 40%. It's a really big bite. But for most everybody else, normal people who have
what I call the rest of us mortals,
us mortals and normal people, we're not going to get anywhere close to that exemption. And so because of that, if you were to give a gift in 1 year that's a little bit too big, you file the 709, the IRS reduces your estate tax exemption, nobody cares. It's not going to impact you. It's not going to impact anybody in any practical way.
So just to restate it, you'd have to give away in your lifetime whatever that exemption amount is. And right now that's $13 million per person, or $26 million between husband and wife in a household. That is a significant number for the vast majority of the people in the United States. I would say 99% of the people will not, maybe 98% will not meet that, will ever meet that. So so that was really designed for people that are super wealthy.
Super wealthy, yeah. And it's to prevent someone, before the end of their life, they have 50 million and they say, I know what I'm going to do. I'm going to give 25 million to my kids now. And then when I pass away, my estate's only going to have 25 million in it. Look, I've tricked the system. Now I fall under those estate tax rules. And they're trying to avoid that. They're saying if whether you pass the assets at your death or you pass them during your life, we want to track them. And so I had a client just a couple of days ago who was talking about helping one of their grandkids with college. And they said, well, how can I do this? I can only gift them so much. And I said, well, if you want to, they're talking about helping them pay for some of these school loans. If you wanted to give them $50,000 to pay for all these school loans, you just have to give them the gift, write them a check, file a 709 tax return, a gift tax receipt. And with that, it'll bring down your lifetime exemption by just a little bit. And they're not going to be close to the exemption. So they said, oh, that's so much easier. I could just do that and file the right paperwork and not even have to worry about it. And so that's one that people feel like they're limited in the sense if they were to give more than the limit, like the 18,000, they have this feeling they have to either pay taxes or get in big trouble. And it's really nice to be able, as we talk through people, to really alleviate that concern and say, yeah, you have to file some paperwork. But beyond that, for most everyone, it's not going to be a negative impact.
Yeah, most of our conversations we have with clients, we get into the estate planning. And of course, what we try to encourage people is to help their family. And so your children, your grandchildren, if they're worthy of receipt, in other words, if they don't just blow the money doing stupid stuff, I always tell clients, you want to test them on small gifts first and see how they respond to it. If they come up to you and say, Dad, can I borrow some money from you? I don't like interfamily loans, but again, I would say test the water first. Allow your child to fail small. Allow your grandchild to fail small. Now, if they're worthy of the receipt of the gift, then you could be a little bit more generous and a little bit more thoughtful about what you want to do for that child, like helping them buy a house, helping them start a business, because you know that they're capable of handling it because they have not failed in the small events previously. I think the worst thing you can happen is all of a sudden a parent gives a child, or a grandchild for that matter, a large amount of money with the full expectations that they're going to know how to manage it. And oftentimes that doesn't happen. That's a learned process that people have to go through, a grandchild such as that. But again, you don't want to use money as a weapon. I think that's really difficult for people not to do. Don't cross that line. You want to use it as a tool, and it can be used to instruct and to provide support. But there's a learning process here, right? Yep. So again, all that goes into play.
Yep, and I love even that perspective of having a client, say it's a grandparent generation that has some resources, and they want to make sure that their family is able to enjoy some of these resources. But we've had a lot of clients, they struggle with how to do that. I don't want to just give my kids $200,000. I'm not sure what they're going to do with it. Will they feel like they have to pay it back? One kid would take it in a heartbeat. The other child would say, oh, no, I don't need that, Mom and Dad. I love your comment of trying to fail small or learn small lessons. We had some family friends that their family, they got together, it's kind of maybe a little nerdy, but they got together as the grandkid group. I think there was like eight or nine different grandkids. And they would do like a family kind of stock discussion, and they played these almost like stock games. Like over the summer, the kids, had, I think it was all fake, but like, hey, here's $1,000 of fake money, build a stock portfolio, and we'll see how those stocks do out the summer. They would track it, and at the end of the summer, see which kids had made what money and why and how. And it was that idea that the parents and the grandparents were trying to train their kids and just equip them. Like, they don't have to make money or feel like geniuses, but to say, we want you to be comfortable with the idea that you might have an investment, you might own some stocks, and you might have to make decisions about when to buy, when to sell. And they were just trying to train these kids in like you said, small ways. So if on the fake money, if they lost it all, nobody cared. It wasn't a big concern. So I think it's such a useful idea of how do you train kids with money, and not just the budgeting or credit cards. We should absolutely be doing that. But even this idea of investing or having assets, it's such a good one.
Yeah, it goes along with my saying that nothing good happens after midnight with children. So always be careful what you do, and don't trust your child to always do the right thing. Test it, and make sure that they do it. And it's not, like I said, I don't want the money to be a weapon. I want it to be a tool, and allow them to make good choices going forward.
I like that.
There's a lot of other things that we have to be careful of when it comes to estate planning and giving, huh?
Yeah. So let's talk a little bit. We can shift. So we talked about some very common ones. The people come in about
Right.
let's get title on things. Let's get money. One that I see that comes in is when people do have family businesses. Often it's family. It's not just families, but they have good assets, and they are in a position where either because they have real estate or they have a family business, they are going to blow past some of those exemptions. So say they have $30 million of a business. They have some really great assets of real estate they've built up over the years, and at the moment, they're fine. But 20 years from now, wow, that real estate's really going to be worth a lot.
Right.
And we start talking about this is where it becomes interesting of needing to get some of these assets out of their estate, whether it goes to the kids now, whether it goes into these special types of trusts. And when I was at the law firm, this is the type of estate planning that we would do on a regular basis. It was the larger, higher end, complex estate planning. And to me, it's fun. How do we? It's almost like feels a little bit like a how do we structure things so that we get the results we want, and you're using irrevocable trust so it's a little bit permanent of what you're doing. And it's fun strategy, but I think people have to realize that type of estate planning is not just a, hey, I heard about this thing, I'm going to throw my
Right.
friend's name on it, or my kids are going to put their name on it. Like it's slow moving. It's thinking proactively. It's thinking long term. We've had a number of clients who will do a bunch of really good estate planning, and then their life changes. And 10 years
A
later,
spouse dies.
yeah,
All of a sudden, there's a complete change, business partner breakup or whatever. Right.
yep. And they're trying to unwind some of these more complex estate planning items. So I guess as the comment is to say, hey, if you have a larger estate, you have some really good properties that are going to appreciate and go beyond 26 million. If you have a family business that's really doing well and it's going to have a high valuation, there's a lot of ways to structure that so that you don't have
Right.
that big bite. But it's going to take some time. It's going to take some thought. And for what I love to do, it's the coordination of your regular finances and your estate planning finances. And how do you merge those in a way that is useful, that's functional? The tax code is full of so many interesting ways to do that. Someone like me who likes to read the tax code, but there's great opportunities there. And I think people, what we find is there's a whole realm of things that they just don't know about. And I think why would they? But they hear things from the news or from their
Right.
friends, and they come in with all these kind of distorted ideas. And I love getting to sit down with them and say, "Hey, you've done really well. How are these assets going to impact your next generation? What do you want them to do? Like, how do you want this to
Mm-hmm.
really benefit your family for multiple generations?" And then we start building something, in their estate plan that makes sense for them.
Yeah, and I think that reading an article written by some person that contributed to a Costco magazine that talks about estate planning isn't going to work for somebody who's got 20, $30 million. Business owners and such as that. The other thing that since I've been in the business for about 40 years, the tax code has changed a lot.
Hmm.
Going back to the early 80s and through the Reagan administrations and on through Bill Clinton and on up, they have changed the exemption amounts and the treatment of certain assets and such as that. Tax is complex. It is not simple. It's just not filing your tax and pay your tax and you go on with your life. If you really want efficiency, you've got to do planning. You got to do tax planning, and you
Yeah.
got to revisit it from time to time, right?
Yeah, and at death, there's a lot of opportunities.
Right.
I was just talking with a client yesterday that said, "Hey, there's all these." Explained a few different great opportunities, but I said, "But the negative is somebody has to die to get these."
Yeah.
However, if we structure these in such a way, when death does come, as it does for all of us, there can be a huge benefit for the family. I like your comment, even that exemption. We talked about earlier that estate tax exemption for a married couple is around 26 million right now. That's supposed to sunset at the end of this year. And those numbers may change meaningfully. It may go from 26 million all the way down to 12 for a married couple, which would be closer to 6 for someone who's individual. And $6 million is still a massive amount of money. But
Right.
for people who are property owners and landowners here in California, people who run businesses, people who've had really solid careers, that number is not so far away that they don't have to be concerned about it. So there's a number of folks later this year, as we go through 2025, that if the law is changed and that those exemptions are extended, those larger amounts are extended, well, then it's not a big deal. But if they're not, if they're not extended, there's going to be a flurry at the end of 2025 of people
Oh
really
yeah.
locking in some major changes to their estate plan to make sure they can use these higher exemption rates.
Yeah, let me throw a caveat in here too, by the way. When you do a net worth statement, a lot of people have $1 million, $2 million in retirement accounts. So whether that's held in a 401k or a solo IRA account, the step-up basis that we've talked about earlier doesn't apply to that. You get transferred to the person you want to get or people that you want to get the assets to. It goes by beneficiary designation. And under the rules right now, if you're a non-spouse receiving that, there's a 10-year payout. And all that money, depending upon how you see it coming out to you, is your income taxed on that. It is whatever it is based on your income tax bracket. So that's just a caveat that I wanted to kind of throw out there a little bit.
Yeah, that's a great comment. That's a very normal when we talk about estate planning. We have to talk about what are the things that go in someone's trust. What are the things that transition by beneficiary designation? There's even, insurance proceeds often are tax-free. And so we talk about that, whether or not they're included in the estate or if they're kept out of the estate. There's a few different characteristics of different types of property. And they're worth a conversation. They're worth a conversation to think through, is my estate not just the house I'm thinking about, but all of my assets, my retirement assets. We've had some people that their pension plans have some survivor benefits to them that flow not just to their spouse, but even to their kids. And so we want to plan that as well. We want to make sure it's as holistic as it can be. So this is a little bit of deep water, we're talking about today, but these are the common things that I see and that you see that people just don't understand how the laws work. And just a little bit of a conversation, a little bit of perspective, man, it can save you for some major pitfalls.
Yeah, and I think the transition is so critically important in families. And oftentimes families say, well, they'll take care of it. They kind of pass it off. And people don't wake up in the morning and say, oh, yeah, I'm going to go do estate planning. I'm going to talk about my death and transfer of assets. It's just not something that you look forward to, right?
Yeah. And the joy I think that we have of being able to sit in those spaces is when we're doing financial planning, we're doing goals, vision, cash flow. We're talking about all the things they want to talk about, getting a handle on their finances. We're able to move very seamlessly into the estate plan and include that conversation. I love it, my background being an attorney, when we can just help people check that off their list. To say, I was supposed to get an estate plan. I've been told to get an estate plan. I've never done it. I don't want to do it. It seems like a lot. And we just say, well, how about we just get it done? And, based on this conversation, this is enough for us to put together your estate planning. I love it when it can get dealt with and that safety net is built for those families.
And as a firm, we're wealth management. So going back into what Jeremiah is talking about, this is what we do. We don't just do investment work for people. We're looking at the estate planning, the retirement planning, the income planning, all the things that are critical to your household from an economic standpoint. It may be something you haven't even thought about, but we bring it up and we say, let's talk about this now because we don't want to try to make decisions when we don't have any time left. So those are things that are really critically important. And as a wealth management firm, we want to take the whole process to look at all those avenues so that we are covering all that for our clients. If you would like to know more about what we do, I strongly encourage you to reach out to us. You can go to our website, tricordadvisors.com, or just give us a call on our phone number, which is 951-684-7011. Till next week, folks, may you grow in wisdom and knowledge. Thank you for listening.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordadvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordadvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.